Welcome. I'm Thorsten Beck, the Director of the Florence School of Banking and Finance, and I welcome you to this edition of the Director's Table. Today, I have the pleasure of talking to Ross Levine, who is a professor at the Hoover Institute at Stanford University. Ross has a long track record of working in areas of finance and growth, but also in financial regulation and financial crises. We're going to talk today about the global financial crisis of 2031. Yes, you heard this right. 2031. When will and how will the next global financial crisis happen? Because we know that crisis will always happen. Yes, some people say this time is different, but we know that after the fact, this time was maybe not different. It had a different form, a different shape, a different color. But yes, crises keep on happening. And that's what Ross and I are going to discuss about today. So Ross, let's start with taking a look back. 2007, 2008, the global financial crisis as we know it, caused, well, there has been a lot written about it, but over time, so it's hard to talk about causes, triggers and so on, but imbalances had developed in the real estate market, the subprime mortgage markets, and then suddenly the market turned for the first time in US history. House prices went down across the US, and ultimately that had trigger effects not just in the US, but across the Atlantic. So it was, you could argue, a real estate cum credit bubble, then the bust, and then the crisis. This time is different, of course. Where do you see currently the kind of the imbalances, the frictions that might lead us again to a similar situation of systemic risk?
So I think that the crisis of 2007, 2008, and the current one that's building that we're going to date as 2031 come from a similar source. Less some vague notion of an imbalance and much more a notion of incentives. That in 2007, 2008, and I think to an even greater degree now, the supervisors and regulators, and I'm going to focus on the US, although I don't think it's exclusive to the US, created an environment that encouraged the leaders of the major banks and other financial institutions to take excessive risks. And by excessive, what I mean is not the normal risks that financial institutions have to take in order to make money, and that's healthy for the economy and economic growth, as you and I together have done a lot of work on, but excessive in the sense that above and beyond those normal risks, the supervisory and regulatory environment encouraged those bankers and other executives to take on much larger risks because they were searching for the risks themselves. And I think that that's what's building up now as well. So it's one common cause that will manifest potentially in different ways.
So lots of risks, lots of potential losses. There's something missing here, right? I mean, because I think this is the usual coin flip. Head, I win, tail, you lose, right? Because they don't have to exactly take the losses when things go terribly wrong. I mean, exactly. I think that's what you mean by the incentives. So.
Yep. So, for example, in 2007, 2008, it was pretty clear for the banks and the investment banks that they could take on lots of risks, and if things went bad, the government would come in and bail them out. The whole notion of too big to fail. And indeed, when things went bad, the government, or in the form of the Fed, did come in and bail out everybody to a much greater degree than anybody anticipated. For example, if we were having this conversation 30 years ago, I don't think either of us would have expected the Federal Reserve to, for example, bail out Goldman Sachs, and that's what they did. If we fast forward to the present, in the interim, there's been Dodd-Frank, in order to, quote, fix the things that were wrong in 2007, 2008. But what Dodd-Frank did was it actually made much more explicit that the Federal Reserve was in charge of or responsible for the safety and soundness of all systemically important institutions. It's not even clear whether it's financial institutions. So this provides a much broader safety net because if the Fed is in charge of making sure they're safe and sound, then if they fail, this is obviously a failure of the Fed and their responsibility to bail out institutions. So I think we're working in an environment now in which the too big to fail notion, the doctrine that the Fed will bail out financial institutions, is much broader, meaning not just banks, not just investment banks, not just money market mutual funds, but insurance companies and other financial institutions as well.
Which is seen a little bit in 2007-8, right? I mean, firstly, when the money market funds broke the buck, as they said, they couldn't redeem on par anymore. Then basically the Federal Reserve stepped in. Similarly, AIG was ultimately bailed out. It's an insurance company, but it was they had a critical role in the CDS market, the credit default swap market, and ultimately because they were afraid a breakdown in the CDS market would then sweep throughout the financial markets, they also bailed them out, right? But you would think that if the Federal Reserve, or a central bank more generally, has the task for financial stability, then it also should come with the equivalent of regulating and supervising the institutions that ultimately might fail, no? Yep. And is that not the case, or is?
So I think this is where I call the U.S. a bit schizophrenic, because you can have a policy regime in which there is an understanding by the public that the authorities will not bail out financial institutions. And that would be a market-oriented financial regulatory system. That works as long as everybody believes that the authorities really won't bail out those financial institutions. That works. Yeah. And in that context, there's really not the same need for the government to then regulate what financial institutions can do. However, if the government is going to bail out those financial institutions, or has demonstrated that it will in almost all circumstances, so that the public believes that it ultimately will, then if you want financial stability, the authorities must do something to constrain those excessive risk-taking incentives. The US currently is content with the bailout culture, but is uncomfortable with the regulatory and supervisory mechanisms necessary to even try to constrain that excessive risk-taking. And that's why I believe that unless the US alters course on one of those realms, either getting incentives right or regulatory constraints, the US will have a financial crisis. I'm guessing in about 5 or 6 years. That's why 2031 is the date. And it's also because that's about how long it's taken in some past crises for when incentives, but it's not done by any rigorous research. And right now, I'm not very optimistic that the US will fix one of them. It needs to fix at least one of them to be consistent.
So there is clearly a mismatch between regulation and then possible bailout. Of course, you can go two ways. You can kind of say, well, put in stone in law, whatever, well, law not, maybe in stone, in constitution, whatever. No, we will never ever bail out. But that's something what we then economists call the time inconsistency, right? I mean, you can say the optimal policy before is always to say, no, we're not going to bail you out. The optimal policy afterwards is often, not always, often to, yeah, well, we're going to bail you out just one time, yep. Right? And we've seen it just 2 years ago, again, in the case of Silicon Valley Bank, where, no, it was depositors up to 250,000 were made whole. The rest went all straight into liquidation until a couple of days later, they said, oh, well, you know what? Yeah, you're going to get your money back too, because, you know, there's systemic risk exemption and so on. So I think that is exactly what this time inconsistency,
exactly.
Right? Or then I guess the alternative would be to say, well, we just keep regulating, which you could argue a little bit a European approach. I mean, whatever moves, whoop, we're going to regulate you. But that is kind of might then go against innovation, competition. Isn't there also risk on the other side? If we kind of overreact I mean, that's what, for example, different topic, but artificial intelligence. Now the European Union is being accused of being over prescriptive in terms of how to use that. Is there the risk of also going the other way?
Yeah, so I agree with your analysis completely. On going the other way, you and I have spent much of our professional lives on that. So as we have shown together and independently, when restricting competition among banks or when restricting what banks can do or other financial institutions, it interferes with the efficient allocation of capital. And capital is in some sense a notion of opportunity. So you're restricting the efficient allocation of economic opportunities in society. You get lower growth, you get less prosperity. As we've shown, you can get more income inequality because finance tends to expand opportunities for many disproportionately for those at the lower end of the income distribution. A caricature might be that the Europeans are very consistent. They are going to bail out the entities, and then they are going to strangle what those financial institutions can do, the result being slow growth and innovation. The US right now is, like I mentioned, inconsistent. It's going to bail out everything. It's demonstrated that it will, and it's going to, in the process of removing many restrictions, which I think will likely lead to a boom. I just think that risk-taking will ultimately lead to problems and a crisis. And the best, of course, I mean, from my perspective, is that if it can be achieved politically, is to make sure that the people who are deciding on the risks of financial institutions have more skin in the game. Therefore, there'd be less need for official supervisors and regulators to constrain risk because the market, based on sound incentives, would be doing it anyway.
Yeah. Now, I want to come back to and look a little bit deeper into the crystal ball about the current situation.
Okay.
So one idea that I have, and maybe you can shoot it down, is that you have a new type of money market funds. And we call them stable coins. Basically a structure where you offer a private kind of money-like instrument which is backed up by treasury bills or other so-called safe assets linked to the US dollar, which works fine as long as there's at par and these structures work well. But of course we also see that, for example, when interest rates move quickly, for example, or in liquidity crunch situation, such structures can easily come under pressure, and then the question is either they break down or somebody steps in the form of lender or market maker of last resort. Would you see something like similar happening now with would you agree that the stable coins could be one source, or do you see other sources that kind of can build up these imbalances which ultimately might lead to the next crisis?
So, yes, I definitely think that the next crisis could be based on stable coins. It could even be the main way in which it manifests, but I look at it a bit broadly. And that is that the regulatory supervisory incentives in the US give the people running financial institutions huge incentives to take risk. Why are there huge incentives to take risk? Because if those risks pay off, they can earn generational changing returns. Not only will they be rich, their children will be rich, and their grandchildren will be rich. And they can take those gambles with no downside risk because the official entities will bail them out. And so and there's nothing illegal, so they will take on those risks. Could be stable coins, it could be real estate like in 2007, 2008, and like in the savings and loan crisis a few years before that, a couple decades before that. It could be taking on exchange rate risk like in Mexico and in Chile, or many other types of risks. I don't know the exact way. I just know that if you give these very smart people huge incentives to take risks, they'll figure out how to do it.
Indeed. So, both of us are old enough to remember the deregulation episode in the US, late 90s, early 2000s, and then the tightening with the Dodd-Frank Act after 2008-9 crisis. Something we would refer to as the regulatory cycle. So in Europe, I think we are just now kind of at the bottom. In terms of tightening, we're top, however you want to see it. It seems in the US, this regulatory cycle moves much more quickly, right? So you go, you had few years after the global financial crisis where the Dodd-Frank came in, tightening, new supervisory powers, new regulatory restrictions. And then in 2017 already with the first Trump administration, there was already some loosening, which was kind of put on hold but not really reverted during the Biden administration. Now it's like really anything goes again, pure laissez-faire. I mean, what drives this? I mean, are people don't remember, or people don't want to remember?
So I think, so I wouldn't call it laissez-faire because it's only laissez-faire on one side.
Yes.
So the push now is laissez-faire in terms of not having regulatory restrictions on what financial institutions could do, but those same individuals are doing nothing or recommending nothing in order to address the supervisory and the regulatory incentives that come from too big to fail that push those entities towards taking excessive risks. So I think there is this schizophrenia. The US wants a market-oriented approach, and a market-oriented approach means accountability, and that would mean that the regulators let financial institutions fail. But as you pointed out, once the crisis hits, they don't want what's going to happen from a crisis, and so they bail the entities out and then promise not to do it again. But of course, once they do it and they've shown why they do it, people don't believe them. And the incentives come from the investors believing they'll be bailed out, not what ultimately happens. And the Federal Reserve has demonstrated quite clearly that it will bail them out. I think in terms of do they believe, what do the authorities believe? I'm not sure that they fully embrace how powerful moral hazard is. Moral hazard being that if there are protections for investors, they will seek higher risk. And I don't think that's internalized into their decisions.
Okay. So the other point I want to kind of ask you a little bit about is the international kind of implications. So the US dollar has been the reserve currency of the world for the past 70, 80 years now, since World War II effectively. But I mean, looking at it from outside, it seems Mr. Trump is doing everything possible to undermine the status of the US dollar's reserve currency. I mean, there are even some parts and some articles in the big beautiful bill that might allow for capital controls, for additional taxes on foreign investors. I mean, could that be another factor playing into future fragility by taking away this kind of an element of stability by undermining the role of the US dollar? Or is the US dollar so entrenched as the global currency, reserve currency, that not even Mr. Trump will be able to destroy it? And he has been destroying a lot. Huh?
So I think that, I think it'll be, I think when you use the word institutions, I view that as a set of policies or arrangements that tend to change slowly. So there's nothing permanent about the US dollar being the reserve currency. It wasn't in past history in the 19th century, and then it was as the US economy became the most powerful in the world. I think part of what's going on with the dollar and Trump is he wants to weaken the dollar in order to promote exports, because that's part of his vision of American prosperity is to boost manufacturing, and we can agree or disagree about whether that's a smart strategy. I would point out on manufacturing, though, is that manufacturing as a share of employment started declining in the US, I think, in the 1940s. So this is nothing new, and it's been very steady. There's no dramatic increase with China and trade and all of the rest. And it's also true that if you look at the real value of manufacturing output relative to the real amount of everything produced in the US, that's been remarkably steady. And so the notion that manufacturing started this great decline with the rise of China is simply not borne out by the data.
Less labor intensive.
Yeah.
That's
now, and just as if I don't think it's in the U.S. best interest to compete with Vietnam in terms of manufacturing T-shirts. And even if it does compete effectively with Vietnam, it's going to do so through very capital-intensive regimes, not by having lots of people working on sewing T-shirts together in the U.S. On the U.S. dollar and capital controls, if the U.S. pursues that, it's pursuing a very dangerous game, because one of the reasons the U.S. can borrow at such low rates in world markets is because people want to hold that safe asset. And if, to the extent that investors worldwide seek another mode of holding their worth in a more secure fashion, interest rates will rise. The U.S. debt in the U.S. is already at a historically high level as a proportion of GDP, and the population situation in the U.S. is not very good, at least compared to when last time it was high after World War II. So it's not going to have a labor growth in order to deal with that GDP growth, in order to push GDP growth and hence reduce the debt. And then you have Medicare and Social Security, which are enormous IOUs as well. So increasing interest rates in the U.S., making it more difficult to borrow internationally, is a very dangerous game to play. So and that very well could be the trigger for another financial crisis, for sure.
Talking about triggers and coming back to this idea of the next global financial crisis, I mean, so one thing is imbalances building up over time, like boom in crypto, real estate, and so on. The other thing, there's typically a trigger. What could be, are there new types of triggers that we can see now compared to earlier? I mean, the one thing that I think is that what we observed in 2023 during the banking turmoil is that things develop actually much more quickly. So it used to be the case, or kind of the mantra among bank resolution authorities, that we just have to make it to the weekend, and then when we have 48 hours to actually solve things out. Now you might not even make it to the weekend anymore. So the speed has gone up. But how can we think about this going forward in terms of triggers, in terms of speed of these things developing?
So that's a good question. So yes, things happened very quickly in 2023. However, I would point out the following, that I was in the fall of 2022, I was being interviewed to move from Berkeley to Stanford. And as with all recruiting endeavors, there was a dinner. And I was talking to somebody who is now my close colleague and at the time was vetting me, Amit Saru. Who's at the finance professor at the GSB at Stanford and is also a senior fellow at Hoover. And we got into an argument about whether the Fed would increase interest rates. And I said the Fed had to increase interest rates. Inflation had been rising for about 9 months at that point. Larry Summers had called out the Fed for not raising interest rates to fight to deal with inflation. And it was the defining feature of the Federal Reserve Chair's reputation. So they were going to have to raise interest rates. And Amit, this comes back to your point about how fast it is. Amit pointed out, because he had been engaged in very detailed examination of the financial stability of banks, Amit pointed out that if they raise interest rates, the banking system is extraordinarily exposed to an increase in rates, and that many banks will fail.
Yeah, because higher interest rate implies that the market value of the bonds that the banks are holding actually goes down.
Exactly.
Which might not always, if they have to mark to market, it will show up immediately. But as in the case of SVB, if they don't have to mark to market, it's an implicit loss, it's not an explicit loss. But of course, once depositors start running, it turns from an implicit into an explicit loss. So that's
exactly. Thank you. And so, I said, I think that I said, well, they're going to raise interest rates. And Amit said, if they raise interest rates, they're going to fail. The banks are going to fail. And it turns out we were both right.
Yes.
They increased interest rates and the banks failed. Now, this sort of points out to me that while things happen fast, they didn't happen that fast, because they started raising rates. Actually, they started raising rates in 2022. I may have it right. So I have the date slightly wrong. I was interviewing with Amit in 2021. They start raising rates in 2022. What happens when they start raising interest rates is that some of the banks had been paying to hedge, paying basically insurance against a rise in interest rates. Once interest rates rose and they now had lost lots of money. They no longer paid the insurance because now they were essentially gambling for resurrection. And what the bank started to do is have an even greater mismatch in their securities holdings, which exposed them to even bigger losses, at least at book value, if not or at least at market value, if not at book value. So where was the Fed during that year before things happened?
That's a good question.
Okay, and then you say, everybody brings up those wonderful stress tests. And isn't it just brilliant that in all the stress tests, the one stress that the Fed didn't consider was a possible increase in interest rates?
Yeah.
This is at a time when interest rates were at historic lows, and this is at a time when inflation was picking up.
Yeah.
So incompetence is not too harsh of a word to use. And what it says to me is, it raises the question, if the Fed cannot deal with something as simple as a maturity mismatch on US Treasury securities, there's nothing simpler than that. How can it possibly deal with the myriad of risks that banks can engage in?
I want to push back a little bit on this incompetence. And it comes, maybe I was biased because I talked to a lot of people at the ECB, the ESRB. And maybe we can also call it groupthink. So I remember discussions at the ECB, ESRB about these low for long, low interest rates. And then it suddenly was lower for longer. And then entering the pandemic, it was like, well, the interest rates are going to stay below zero for the next decade or so, given how we're doing. And then suddenly they didn't. And they went up like this, right? So it is maybe the inability to the focus on extrapolating from our experience from the last year to the next couple of years, and not this inability to think outside the box and imagine there could be scenarios which are completely different from the path that we've been on for the last, let's say, 5 or 10 years. And I think coming back to the trigger that we mentioned earlier, I think that could exactly be. We are on a path, and we know it's risky, there are imbalances, but we can maybe not quite imagine what will be the trigger that really kind of completely pushes us off the path and then into all kind of turmoil.
So I think that I'll push back again. So I think there can be groupthink. I think that there can be conformity. I think that's a big issue. I would also point out that given that there's so much groupthink and so much conformity, which I think also explains 2007, which also could be used to explain 2007, 2008, if that is such a strong feature of human nature, then I think we need a different approach.
Yeah, that's easy.
However, I would also point out the 2023 crisis is so simple that it's a good illustration here, because Larry Summers and others start arguing in 2021 that there are inflationary pressures. This kind of goes around. I have my talk with Amit at the end of 2021. The Fed starts increasing interest rates in 2022. Now, all of the data that Amit had about the banks being extremely exposed was not proprietary to Amit. The Fed had all of that data. In 2022, you see the hedging positions of all the banks change, and you see them taking on more and more interest rate risks as the interest rates start to rise. Inflation is picking up, interest rates are at historic lows, and then things explode in March of 2023. So to me, that is much more of a demonstration of incompetence than simply of groupthink.
Okay, well.
But one way or the other, given that there's so much conformity, I am very pessimistic about putting so much responsibility in the hands of official supervisors and regulators who can't recognize basic interest rate risk, whether it's because of incompetence or conformity.
Okay, good. Well, point well taken. We've come to the end. We could go on and on, of course. Let me just make one point very clear. I think neither you nor I are predicting the timing of the next global financial crisis. I mean, we kind of
I
started
thought
out.
I was 2031 when
Okay, well, okay.
when I
Well,
responded to you.
Well, you want to bet a bottle of champagne on that? That's fine. 2031 it is for you. I would certainly not predict the exact timing. I remember there were some people in the early 2000s who were predicting a banking crisis in the US. Eventually they got it right, but it took a couple of years. But anyway, so but I think what we both agree on, there are imbalances building up. It is very clear that they're building up and that nobody's really doing anything about them and that they are being allowed to be built up. We don't quite know what the trigger will be. There will be a trigger eventually. Again, I would say it could start even in 2 or 3 years already. It could be 28, 29. It could be 2031, as you say. It could be 2033. But I think the way it's going, yes, I think we both agree we are rather pessimistic. And this time it might be worse, actually, because you also have less international cooperation, of course. So that's the last point I want to make, because you have this kind of hostility of the current US administration against international cooperation. So that is, of course, another big concern, which maybe we can discuss in a different setting. So
Fantastic.
Thank you very much,
Thank you,
Ross,
Thorsten.
and thank you very much, our viewers.